In finance, discounted cash flow analysis is a method of valuing a project, company, or asset using the concepts of the time value of money. All future cash flows are estimated and discounted to give their present value. The sum of all future cash flows, both incoming and outgoing, is the net present value, which is taken as the value or price of the cash flows in question. Present value may also be expressed as a number of years' purchase of the future undiscounted annual cash flows expected to arise. Using DCF analysis to compute the NPV takes as input cash flows and a discount rate and gives as output a price. The opposite process taking cash flows and a price and inferring a discount rate is called the yield. Discounted cash flow analysis is widely used in investment finance, real estate development, corporate financial management and patent valuation. Discount rate. The most widely used method of discounting is exponential discounting, which values future cash flows as how much money would have to be invested currently, at a given rate of return, to yield the cash flow in future. Other methods of discounting, such as hyperbolic discounting, are studied in academia and said to reflect intuitive decision-making, but are not generally used in industry. The discount rate used is generally the appropriate weighted average cost of capital, that reflects the risk of the cash flows. The discount rate reflects two things: time value of money. According to the theory of time preference, investors would rather have cash immediately than having to wait and must therefore be compensated by paying for the delay. Risk premium. Reflects the extra return investors demand because they want to be compensated for the risk that the cash flow might not materialize after all. History. Discounted cash flow calculations have been used in some forms since money was first lent at interest in ancient times. As a method of asset valuation, it has often been opposed to accounting book value, which is based on the amount paid for the asset. Following the stock market crash of 1929, discounted cash flow analysis gained popularity as a valuation method for stocks. Irving Fisher in his 1930 book The Theory of Interest and John Burr Williams's 1938 text The Theory of Investment Value first formally expressed the DCF method in modern economic terms. Mathematics, discounted cash flows. The discounted cash flow formula is derived from the future value formula for calculating the time value of money and compounding returns. Thus the discounted present value is expressed as where DPV is the discounted present value of the future cash flow, or FV adjusted for the delay in receipt. FV is the nominal value of a cash flow amount in a future period. I is the interest rate or discount rate, which reflects the cost of tying up capital and may also allow for the risk that the payment may not be received in full. N is the time in years before the future cash flow occurs. Where multiple cash flows in multiple time periods are discounted, it is necessary to sum them as follows. For each future cash flow at any time period in years from the present time, summed over all time periods. The sum can then be used as a net present value figure. If the amount to be paid at near zero for all the future cash flows is known, then that amount can be substituted for DPV and the equation can be solved for I, that is the internal rate of return. All the above assumes that the interest rate remains constant throughout the whole period. Continuous cash flows. For continuous cash flows, the summation in the above formula is replaced by an integration. Whereas now the rate of cash flow, and example DCF. To show how discounted cash flow analysis is performed, consider the following simplified example. John Doe buys a house for $100,000. 3 years later, he expects to be able to sell this house for $150,000. Simple subtraction suggests that the value of his profit on such a transaction would be $150,000 or $100,000 equals $50,000, or 50%. If that $50,000 is amortized over the 3 years, his implied annual return would be about 14.5%. Looking at those figures, he might be justified in thinking that the purchase looked like a good idea. 1.1453 x 100,000 equals 150,000 approximately. However, since 3 years have passed between the purchase and the sale, any cash flow from the sale must be discounted accordingly. At the time John Doe buys the house, the 3-year U.S. Treasury note rate is 5% per annum. Treasury notes are generally considered to be inherently less risky than real estate, since the value of the note is guaranteed by the U.S. government and there is a liquid market for the purchase and sale of T-notes. If he hadn't put his money into buying the house, he could have invested it in the relatively safe T-notes instead. This 5% per annum can therefore be regarded as the risk-free interest rate for the relevant period. Using the DPV formula above, that means that the value of $150,000 received in 3 years actually has a present value of $129,576. In other words, we would need to invest $129,576 in a T-bond now to get $150,000 in 3 years almost risk-free. This is a quantitative way of showing that money in the future is not as valuable as money in the present. Subtracting the purchase price of the house from the present value results in the net present value of the whole transaction, which would be $29,576 or a little more than 29% of the purchase price. Another way of looking at the deal as the excess return achieved is /100 plus 5, or approximately 9.0%. But what about risk? We assume that the $150,000 is John's best estimate of the sale price that he will be able to achieve in 3 years' time. There is of course a lot of uncertainty about house prices, and the outcome may end up higher or lower than this estimate. The house John is buying is in a good neighborhood, but market values have been rising quite a lot lately and the real estate market analysts in the media are talking about a slowdown and higher interest rates. There is a probability that John might not be able to get the full $150,000 he is expecting in 3 years due to a slowing of price appreciation, or that loss of liquidity in the real estate market might make it very hard for him to sell it all. Under normal circumstances, people entering into such transactions are risk-averse, that is to say that they are prepared to accept a lower expected return for the sake of avoiding risk. See capital asset pricing model for a further discussion of this. For the sake of the example, let's assume that he values this particular risk at 5% per annum. Therefore, allowing for this risk, his expected return is now 9.0% per annum. And the excess return over the risk-free rate is now /100 plus 5, which comes to approximately 3.8% per annum. That return rate may seem low, but it is still positive after all of our discounting, suggesting that the investment decision is probably a good one. It produces enough profit to compensate for tying up capital and incurring risk with a little extra left over. When investors and managers perform DCF analysis, the important thing is that the net present value of the decision after discounting all future cash flows at least be positive. If it is negative, that means that the investment decision would actually lose money even if it appears to generate a nominal profit. For instance, if the expected sale price of John Doe's house in the example above was not $150,000 in 3 years, but $130,000 in 3 years or $150,000 in 5 years, then on the above assumptions buying the house would actually cause John to lose money in present value terms. Similarly, if the house was located in an undesirable neighborhood and the Federal Reserve Bank was about to raise interest rates by 5 percentage points, then the risk factor would be a lot higher than 5%. It might not be possible for him to predict a profit in discounted terms even if he thinks he could sell the house for $200,000 in 3 years. In this example, only one future cash flow was considered. For a decision which generates multiple cash flows in multiple time periods, all the cash flows must be discounted and then summed into a single net present value. Methods of appraisal of a company or project. This is necessarily a simple treatment of a complex subject, more detail is beyond the scope of this article. For these valuation purposes, a number of different DCF methods are distinguished today, some of which are outlined below. The details are likely to vary depending on the capital structure of the company. However, the assumptions used in the appraisal are likely to be at least as important as the precise model used. Both the income streams selected and the associated cost of capital model determine the valuation result obtained with each method. This is one reason these valuation methods are formally referred to as the discounted future economic income methods. Equity approach, flows to equity approach. Discount the cash flows available to the holders of equity capital, after allowing for cost of servicing debt capital, advantages, makes explicit allowance for the cost of debt capital, disadvantages, requires judgment on choice of discount rate, entity approach, adjusted present value approach. Discount the cash flows before allowing for the debt capital, advantages, simpler to apply if a specific project is being valued which does not have earmarked debt capital finance, disadvantages, requires judgment on choice of discount rate. No explicit allowance for cost of debt capital, which may be much higher than a risk-free rate. Weighted average cost of capital approach. Derive a weighted cost of the capital obtained from the various sources and use that discount rate to discount the cash flows from the project. Advantages, overcomes the requirement for debt capital finance to be earmarked to particular projects. Disadvantages, care must be exercised in the selection of the appropriate income stream. The net cash flow to total invested capital is the generally accepted choice. Total cash flow approach. This distinction illustrates that the discounted cash flow method can be used to determine the value of various business ownership interests. These can include equity or debt holders. Alternatively, the method can be used to value the company based on the value of total invested capital. In each case, the differences lie in the choice of the income stream and discount rate. For example, the net cash flow to total invested capital and WACC are appropriate when valuing a company based on the market value of all invested capital. Shortcomings. Commercial banks have widely used discounted cash flow as a method of valuing commercial real estate construction projects. This practice has two substantial shortcomings. 1. The discount rate assumption relies on the market for competing investments at the time of the analysis, which would likely change, perhaps dramatically, over time, and 2. Straight-line assumptions about income increasing over 10 years are generally based upon historic increases in market rent but never factors in the cyclical nature of many real estate markets. Most loans are made during boom real estate markets and these markets usually last fewer than 10 years. Using DCF to analyze commercial real estate during any but the early years of a boom market will lead to overvaluation of the asset. Discounted cash flow models are powerful, but they do have shortcomings. DCF is merely a mechanical valuation tool, which makes it subject to the principle garbage in, garbage out. Small changes in inputs can result in large changes in the value of a company. Instead of trying to project the cash flows to infinity, terminal value techniques are often used. A simple annuity is used to estimate the terminal value past 10 years, for example. This is done because it is harder to come to a realistic estimate of the cash flows as time goes on involves calculating the period of time likely to recoup the initial outlay. See also. References. External links, Continuous Compounding Cash Flows, The Theory of Interest at the Library of Economics and Liberty. Monography about DCF. Foolish use of DCF. Motley Fool. Getting started with discounted cash flows. The Street. International Good Practice, Guidance on Project Appraisal Using Discounted Cash Flow, International Federation of Accountants, June 2008, ISBN 978-1-934779-39-2, Equivalence between Discounted Cash Flow and Residual Income Working Paper. Duke University, Center for Health Policy, Law and Management, download of business case spreadsheets for discounted cash flow calculation http, www.thebusinesscase.info. Further reading, International Association of CPAs, Attorneys, and Management, International Federation of Accountants. Project Appraisal Using Discounted Cash Flow, Copeland, Thomas E. Tim Collar. Jack Murrin. Valuation, Measuring and Managing the Value of Companies. New York, John Wiley & Sons. ISBN A0-471-36190-9. Damodaran, Aswath. Investment Valuation, Tools and Techniques for Determining the Value of Any Asset. New York, John Wiley & Sons. ISBN A0-471-13393-0. Rosenbaum, Joshua. Joshua Pearl. Investment Banking, Valuation, Leveraged Buyouts, and Mergers and Acquisitions. Hoboken, New Jersey, John Wiley & Sons. ISBN A0-470-44220-4. James A. Hitchner. Financial Valuation, Applications and Models. USA, Wiley Finance. ISBN A0-471-76117-6. Shanda Sawani. Discounted Cash Flow The Prominent Income Approach to Valuation. India, 1, A.